Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Good morning. Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement here on the show. Our show is all about building up wealth, understanding the world today, protecting your retirement, and getting through retirement. Our motto and our philosophy is to save aggressively and invest conservatively. That's save aggressively and invest conservatively. And that's the way you build up wealth. You conservatively put away the money. You aggressively put away the money. You conservatively invest it. And you build up a safe retirement. And this is a lesson learned this last week with many people that were aggressively investing in the market and speculating all over the place, and then all of a sudden the markets pretty much blew up and there was losses. I think the majority of the stocks, over 2/3 of the stocks, are down 20%, and it's just it's pretty remarkable to see what's happened and to see where things are going. But this is the world we live in. You have to prepare. If you prepared for this, I mean, we write a lot about this in the Max Out Savings Report. You were able to ride through it, and so by conservatively managing the money, by being smart, by watching out, looking at the world, figuring out where it's going to go, you can protect yourself in retirement. As we talk, oftentimes, retirement is a long-term game. You're talking 20 years or more, some cases 30 years of retirement. You've got to have those assets. They have to work for you long-term. You have to make positions long-term and ride it through. But you have to have a broad-based, diversified portfolio. If you look through any 50-year period of history, there's lots of times that the markets don't go up all the time. But if you come up with those ideas to make money in those markets, you do real well. But if you're just indexing, then you're going to get yourself in trouble. And so this is one of the things we've talked a lot about on the show here. And so let's just kind of we're going to be covering some of what's happened in the market this week, where we think things are going. Why is it happening? We're going to be going over this just to lay out the broad brush of what's going on here. The markets have had a substantial sell down. They've had a good run for 2 years, and prices were very high. PE ratios were very high. Price to sales was very high. Price to free cash flow was on virtually every metric. It was sky high. One of the more disconcerting ones that were out there we talked about is the United States was reaching like 70% of the market capitalization for the entire world. We're about 26% of the global economy, 27%. So it was just, the markets were very highly valued going into the year. President Trump takes over. All the COVID spending ended last year. We went through 4 years of averaging about 6.5% of deficits every year. This was after the COVID. The economy was reopened, inflation was going. They're still spending money like no tomorrow. 6.5% of GDP. The only time you can really see those levels, we've never seen those levels of spending without a war or a very deep recession. We had a good economy. We had 3.9% jobless rate. The money was just raining from the sky under the Biden administration. They had basically a mentally impaired president, and they had an auto pen, which, the signs the president's signature. So they were doing whatever the hell they wanted up in the White House, spending money infinitely. But it all came to an end. And so really, there was no doubt the economy was going to slow down after that orgy of spending we saw. It's just done. And then here comes the Doge Commission, and they're trying to cut spending because they're like, wow, we're spending 6.5%. We can't keep doing this. There's a story today in the Wall Street Journal. Secretary Bessent, who, listeners, I think we're very fortunate to have him. He's a brilliant Treasury Secretary. He's looking at this and going, hey, this is going to all collapse and end badly, and the United States is going to become a failed state unless we do something. So he basically volunteers to be Treasury Secretary and was recommended in there, and Trump liked him, and we're very fortunate. He's got 30, 40 years of macro experience in hedge funds, which is invaluable in this type of world. And so he's going to, he recognizes the danger the United States is in. So they're trying to cut spending. Elon Musk has helped with the Doge Commission. One of the surprises in the Doge Commission is just the sheer size of the corruption, which has stunned everybody. I mean, it was just, as we said, I think you got to go back to Roman times before you can, something like Caligula, Emperor Caligula or something, where you had an insane insane emperor to really see what we've seen in the United States. And so he's trying to cut 5-6% of government employees. That's going to slow the economy. They're cutting government spending. That's going to slow the economy. So right before the trade war started, we were already the stock market was already declining, and it was because people saw the slowdown was coming, and so Trump had to, and then Trump puts the trade things on, and it just accelerated it even more. I mean, when Trump announced these trade deals, the S&P 500 was already below the 50-week moving average, which is a very clear message that things aren't going right. And so what I want you to understand is this isn't all about tariffs. This market didn't plunge down from the beginning of the year because of tariffs. It didn't plunge down because of Donald Trump. Tariffs contributed to some of it, but President Trump is given a situation that unless he acts very quickly to stabilize the situation in the United States, we're headed for a downgrade. We still might get it. We're headed for higher interest rates. We're headed for massive hyperinflation and the destruction of the United States. So he has to act quickly. And he's got a very narrow Republican majority. If he doesn't get it done now, they're going to get kicked out. The Democrats are going to be back, and they're going to be spinning again. So they have to act quickly. He's acted as the only president that's acted more aggressively, more quickly, and more forcefully has been Franklin Delano Roosevelt. He came into it during the Depression and had to act quickly, and it's the same type of situation. So understand, this is the world we're dealing with today. We're dealing with an unstable situation. We're dealing with a lot of concern. And one of the concerns I'm looking at is, if you look at what this is very similar to is if in a big corporation, if a big corporation, things are going well. Let's say it's an oil company, because people in Houston can understand it. Oil's trading around $100. All of a sudden, it goes down to $30, and you've got to lay off people. Everyone's concerned. There's a lot of concern. People aren't sure if they're going to have their job, even though if they're sure their job is safe. They're still thinking maybe they could get laid off. So everybody's nervous, and it causes problems. It's the same thing now. Now, the situation is not being helped by the mainstream media and the Democrats, because they know is what. Here's what they know. They know they had an incompetent president and they deceived the American people. They know everybody knows that. They lied to the American people. They know they recklessly spent money. Every single one of them in their heart knows it. And so they know what's coming. They have to blame this on Trump so they can get in power. So if they can panic the public into dumping all their stocks and crashing the stock market, that's a good thing for them. Hey, it wasn't our fault. Things were going pretty well under Joe Biden. We could just bring back the senile lunatic. The market would actually be up and the economy doing real well. And so they're talking it up. I mean, it's really profoundly un-American to hear these big news organizations and in some cases the Wall Street Journal even rooting against the United States of America so they can, since they're anti-Trump and they wanted to. Wall Street's not always anti-Trump. But there's a clear group in there that wants basically corporate America to get whatever they want and don't want the populist in there. And so here we are. This is making the situation worse because typically when you're dealing with tough issues like this, it's like this is a trade war. It's a war. It's like any other war. You want the country to pull together in war to win the war. And instead, the Democrats and the mainstream are trying to separate everybody out and cause infighting so the war fails and Europe and China are successful. It's profoundly un-American, but in their mind, Trump is a bigger threat than the Chinese taking all our manufacturing jobs, than the dollar collapsing anything in the world. What they're hoping is they can put their guy in there, they can get rid of all the Republicans, and maybe never have an election again because Donald Trump is a dictator. They can't ever risk having Donald Trump in there, so they need to take over the whole country. I mean, it's a higher level of insanity with these people, and so. I mean, I don't mean to pick on the Democrats, but clearly a lot of them have let their hatred for Donald Trump, President Trump, blind them to the realities of the world today, and that makes it a more dangerous place for the rest of us. And so here we are today. The market's gone down. We've gotten engaged in a trade war, and so what we're seeing is the Europeans. Trump has frozen the tariffs, saying, look, we're not going to do anything more. We're putting a moratorium on the tariffs. There's just going to be, I think, a 10% tariff on everything. And then we got so many people coming to negotiate with us. We're going to sit there and do that, except for the Chinese, which are a problem. And one thing we must understand about the Chinese are the problem. I mean, it's not just tariffs, it's rules to keep American products out, it's technology. I mean, in the 1990s, we had client at DuPont, like Ted. We built a factory in Xinjiang or wherever the hell it was over there, and we started building. If within a year or two, a factory showed up 5 miles down the road producing exactly the same product and stole all our technology, and it was. This has happened continuously in China. We've kind of stopped them from importing a lot of stuff in the U.S., and now they're flooding the rest of the world with their products and driving down. They're taking everybody's job, not just in the United States, but all over the world for themselves, and they're going to have to be controlled. That's not an easy situation. I mean, it is a definite battle with China. It's not going to be easy, but it has to be fought. And Trump's strategy of bringing everyone together to sit there and try to go up against the Chinese, like the Japanese and the Koreans and the Europeans, I think it's a good strategy. But this is going to cause disruptions, and that's what we're dealing with here. These disruptions in the world today. And if you listen to the Trump administration, they're saying a very important thing. Things have gone very well for Wall Street for years, the last 2 years, whatever. But now we're trying to fight for working people in the United States. So you had Larry Fink come out Friday on all the networks saying, well, Wall Street is really tied to working people. When Wall Street does well, working people do well because they see there's a split happening and they're trying to defend it. And they're trying to say, oh, no, what's good for Wall Street is good for working people. But Trump realizes, look, Trump and the MAGA movement and the conservatives realize their future's with the working people. As I've said this on the show, is Donald Trump knew more wealthy people and more powerful people than probably anybody in the world. Yet when after he was president, the Biden administration came after him, indicted him all over the place, and all his wealthy friends couldn't couldn't help him. The working people are the people that rose up to protect Donald Trump. That is his base, He will not abandon that base, and he will fight for that base because those are the people that are protecting him. I mean, if you look in the end, all the lawfare against Donald Trump was a huge mistake by the Democrats. They fundamentally altered the entire direction of the United States of America with Judge Merchan and the people in Washington indicting him for stealing secrets, and then they raided his house, and all of a sudden, like a week later, they find out every other president has secret documents at their house too, but no one else got indicted. But that altered the future, that altered the course of the United States, and it made Donald Trump a much more populist president. And so it was a mistake on their part. Now, so what's happening now? We're going to discuss this right after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings, investments in your retirement. It just so what we have here is we have these tariffs, we have this trade war. Now, President Trump has come up and he said, "Look, hey, we're going to suspend the tariffs. I think except for the 10% tariffs, and then he's also suspended the tariff on electronic equipment, computers, iPhones. So it saved Apple." But yeah, honestly, I would have kept the 10% on a lot of that stuff. I mean, Apple. Yeah, I've talked about these margins. Apple's margins today are 35 to 40%. For the iPhones, it's probably 40%. They were in that 2015. They were 30%. So they're making very good margins on their products. And you know, some of these companies can eat their. I mean, if you want to go play the hey, nobody can manufacture products because there's so much talent in China that no one can manufacture an iPhone except China, Tim Cook. You know, but somehow the Indians can manufacture it. So wait a minute. Yeah, so the Indians have more talent, and they're evidently more able to handle complex factories than the United States of America. We're supposed to buy this line of BS. Okay, they're sitting there making a fortune off their phones. Apple should, suck it up, take a part of their margins to help pay for the taxes, to pay for tax cuts for working people in this country. Now you say, Ted, and this is what one thing we've been saying is, look, the margins on corporate America it's very high. Look, we invest in stocks and bonds, in corporate stocks in the United States. Don't get me wrong, but we're here to make money. We try to position ourselves around these issues so we can make money in it. But we're not going to sit there and cheerlead American corporations moving factories overseas so they can boost up their margins. I'm sorry. If you look at Apple, now the other computer makers got it too. But if you look at the margins on their net margins for Apple is it's about 26%. Bear with me just to say this was interesting. It might bore some of y'all, but I'm sorry, I just can't help myself with this. The net margins on Apple our net margins are about 26%. Okay. On Dell, it's 3.5%. On HP, it's 5%. On Lenovo, it's 2%. So most people aren't making these ridiculous margins for Apple on their products like Apple are. And yet I've heard more crying and wailing and screaming about how Apple's going to sit there and the price for on consumers is going to go up. Well, look at the margins on Apple. That's a question. I just say it again that the gross margins on net margins are 26% on Apple. Their gross margins are 46%. They're even the gross margins, they're 20 to 25 basis points margins above these other computer makers and so basically what Apple wants is they want their cake and eat it too. They want to be able to build everything in China and they don't want to pay any tariffs while everyone else in the country has to pay the tariffs. But they have these margins. It's not like, hey guys, we're barely making any money on these products. Our margins are razor thin. Okay, I'll buy that. Okay, but when your margins, when your gross margins are 46%. So anyway, something to keep in mind. What I try to do with this show is I try to bring you stuff that maybe you don't understand. I want you to understand the world today, and there's so much paid political paid bias or political bias in the media that sometimes if you just sit there and try to get to the truth of the things, it's profound in the fact that nobody else brings this up because they're so busy trying to spin their situation. And it's like that with Apple. So we've got the tariffs coming in. They're going to go back them off 90 days. They're still holding tough on China. So China's going to be the tough one. I think we're actually, it's interesting. We're actually doing pretty well with the Japanese, the Koreans, Taiwan, they're all kind of quiet. They're making a few threads here and there. The Europeans are like, hey, they're talking a bunch of trash. They're much worse. The Canadians are like, oh, you would think we've gone to war with Canada because you got Mark Carney, the globalist, up there. But I think these countries, I think you're going to get deals. I think we're not going to get all the factories back, but maybe part of the deal is, look, we'll put another factory back in the United States. Okay, we'll we'll try to buy more U.S. agricultural products, more U.S. oil and gas, more U.S. chemicals. There's ways what we're saying to people is look, we want a more fair trade. We want the manufacturing in the United States. If we can withstand. If all the manufacturing doesn't have to be there, if in a time of war, if 100% of our manufacturing base on key products or key components are overseas, we lose the ability to make components. I was just talking to someone during the pandemic. Everything was American made. They had one little component that was made in China. And it shut down their operations so they could get it. And so what we have to do is we have to protect the United States in the event of a crisis, in the event of a war, that the United States defense doesn't collapse because everything is being made overseas. So this is it. And we also have to fight for American jobs. Look, I get it. Wall Street makes a lot of money. With all this stuff, and the people on the coast do well importing stuff. But working people in the center of the country deserve fair jobs too. And what people don't understand is in the world coming of AI and stuff, a lot of these service jobs are going to be eliminated. But it's real hard. The AI, they can't go make an automobile. They can't make a tank. They can't make a computer. They can't make things. So in the future, and then the other argument that the globalists have is, well, look, there's no workers in the United States. The factories of the future are going to be robotic. We need very high-level people to service those. So they're going to be very high-paying jobs and high-paying equipment that's going to be made to come into the factories. So that's what we want. We want the high-paying jobs. Look, we're not interested in the Nike jobs. The problem with Vietnam is they had like $160 billion deficit, and they bought like $13 billion or $16 billion worth of our products. You're like, whoa, wait a minute, something's wrong here. And so what the mainstream media, all they talk about is Nike, like we're going to be moving all the factory. We're not interested in Nike shoes. Yeah, they make crappy shoes. They cost them like $20 or something to build. They charge you $150 for them because they slap a Nike sticker on, and then they pay a bunch of athletes like, that are multi-millionaires probably another $20 a shoe. I mean, it's just, that's a losing game. But the factories, the computerized factories, the phone factories, the chip factories, the engine making factories, those are the jobs we want. Those we want them. We don't want them all back, but we need some of them back to rebuild our defenses. So what you understand is this is a restructuring of the United States of America. This is not going to. Nobody said this was going to be easy. If you listen to what the Trump administration said, there's going to be some pain. What did Secretary Bessig say? A period of detox. I mean, I'm sorry, but if you didn't get it when he said a period of detox, it's just, I don't know what more he can say. But there is a path out of this of factories coming, like we've been saying, there's $500 billion worth of factories at a minimum coming back to the United States. That's more jobs. Those are high-paying jobs for American citizens. That's going to stabilize our economy. That's going to build it up. Ultimately, we're going to get lower rates. That's going to help us out. Now, here's a problem near term, because I just mentioned lower rates. Let's take a look and see what the markets did this week. And I think your portfolios were all up. The S&P was up about 5.7%. And so it was a good week for all the machinations that happened this week. Well, anyway, you know what I'm talking about here. I sound like Joe Biden. The market was up. And most of the damage was done by Friday of last week, and so things stabilized. I think we've been very, very, very fortunate. We've done super well this year for our clients. But so where do we are now? A couple thoughts. When markets go down like this, when markets start really going down, it's important to look at the technical picture of the market. Because all of a sudden the earnings, everything else kind of goes out the window, and people don't know what to do. This market, as we said a number of weeks back on the show, we said, look, the market it's had a little pullback, but it's not near pullback supports. So you look at some Fibonacci numbers, which are about 38% and a 50% Fibonacci in the market. Friday kind of bounced around the 38 number, and then it went down almost right to the 50% retracement, which is a 50% retracement of this whole little bull market from 2022 bottom up to this. So all the gains, it went back to 50% of the gains. The number of stocks down over 50% is just incredible right now. And then it bounced off of that. And then over the last couple of days, it's zoomed higher once Trump put the tariffs, put a moratorium, 90-day moratorium on the tariffs. So it stabilized it. So it looks like an interim bottom is made here near term. I think you're going to see a couple things. I think some stocks are still pretty expensive in here. One thing we're looking at some of the cyclical industrial type of stocks. As we said, we believe we're going into some type of slowdown. Right now it doesn't look like it's going to last a long time, and I believe it's going to be stabilized by these factories coming in, and they're going to start coming in over the next, probably 6 to 9 months. They're going to start beginning, planning for the factories. So some of them are already coming back. I mean, some of these people made commitments almost immediately, like 3 months ago, to Trump before he was even in office. So these factories are going to start coming back. but a lot of these stocks have just plunged. Look at some of the chemical companies as an example. They've just, some of these things, I'm looking at them and they're down like 40%. And so we haven't bought those. We're looking at those, but there's other sectors of the market that have been just completely blasted. If you look at copper, and we're big proponents of copper because of electrification, because of electric cars, because of AI, the reindustrialization of the United States. That's all copper. But copper went from about literally in the last 2 weeks. It's gone from about let me see. Let me try to pull this. It's gone from about when was that date? Yeah, actually, it's maybe 3 weeks. Yeah, $5.40 a pound down to $4, and it closed right about $4.50. So big drop in copper. So the copper stocks all plunged down, and so you've seen a lot of decimation in here. Copper was actually up. Oil was up this week. Gold was up 6.5%. If you look at silver was up 8 point something percent, almost 9% there. And a couple thoughts here. If you look at the gold has outperformed everything else out there year to date. Gold's hitting a new high. Gold hit $32.36 an ounce. As we've talked about on the show, the gold has been the big winner. And silver's coming up there. We really like silver here. And what's happened is in this decline, starting Friday of last week, we were watching it during the day. All of a sudden, the bond yield started going up late in the day when the market is plunging and there's wholesale panic. That should never happen. That was I'm going to discuss some more about this stuff. So bond prices, the 10-year is up 50 basis points this week. That's a 12% move, almost 13% move. That is a gigantic move in the 10-year bond. So treasuries weren't the safe haven. The U.S. dollar hit 100. The U.S. dollar wasn't the safe haven either, which typically it is. If you look at the U.S. dollar, it was down about 3%, down to 99.76. Keep in mind, this one in February was 110. So the dollar, we believe that the Treasury would like the dollar lower. If you can get if you can drop your currency 10%, it gives you a 10% edge when selling products overseas and make. So this is something I think they have brought down. So a substantial, nearly a 10% drop in the dollar in here. So gold was the really one that held up. This is why we talked about it so much over the last 6 months, saying, look, this is going to be the play. You have to. Most people are under owned in the sector. They're under allocated in the sector. And if you look what happened, it's real interesting. If you look what happened to Newmont Mining, which is a gold stock. Guess what Newmont Mining was up this week? It was up $10, up 24%. And what happened is people suddenly realized, my God, gold's over, $3,200 an ounce. These people are going to make a ton of money, and everybody is under allocated to the sector. They're all in technology. And they're looking around where to go. The gold and the silver stocks they got 2 or 3 years of very good earnings growth already. If you look over a 4-year out to 2026, the performance is better than a whole lot of tech companies on earnings per share growth, and many of them are at pretty reasonably prices. The numbers I want to say I've seen some $4 numbers on Newmont, and it was at $43 for next year. So I think that the sector. This is why we sort of said, we felt gold was a little high in here, but the gold stocks are really lagging in the silver stocks, and I still feel that's the case overall in here. I mean, as far as the gold goes, it's had such a huge run. This could correct in here any time, but I still think it's this thing could almost correct 10% and still be close to $3,000 an ounce. Think about that, which is going to be very good for the sector. The copper sector is one of the more interesting ones now, just because it's been so beat up, and I think the copper is going to come back up. So we had a stabilization this week of the market. I'll tell you what. So a good week in the markets. We've hit the 50% Fibonacci level, which is for the whole bull market from the end of 2020, mid 2022 to here, which is a good support. It bounced off it. Trump is cut back the tariffs, so more positive things are happening. But we're going to talk about why did the Treasury rates go up 50 basis points, a 13% move, one of the biggest moves in decades for a week, right after this quick break right here on the Max Out Savings Show.
Savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. I'm Ted Gioka. We just want to talk about one of our sponsors, Rangoni Alto Gin, which is a fine botanical gin. It's a completely organic, all-natural botanical gin. It's actually one of the finest in the world, produced in the Italian Alps, brought to the United States, and it's got a flavor profile almost closer to a fine wine. If you get a chance, try it out. It's a phenomenal drink. You can get it at Specs Total Wine. They're starting to expand it. They're just at not all the specs. We're expanding to more now. It looks like, so we'll see. But it's a phenomenal drink, and it's Rangoni Alto Gin. Look for the kingfisher bird on the label. Now then. The market's here. As we talk about good market stabilized, bounced off the 50-day. Hopefully you had a lot of cash and you were conservatively invested. I know we were. And one of the things that did not go well today this week was really the 10-year Treasury bond. That interest rates, went up on the 10-year Treasury to let me see something here. Where is it? 4.5%. It went 6% on the day. This is a huge move up. Last week it was around 3.9%, and this is. Okay, great. Stick with me just a second, Tom. So you're looking at a big move in interest rates, and so that's not a positive because the Treasury is the safety. It's a safety trade, and people were dumping it. Now it could be because there's rumors the Japanese were dumping or the Chinese this week. Last week it was Japanese were selling Friday. Supposedly, and this week it was the Chinese. But there's something called the basis trade or the SOFR, which is like a repo trade where hedge funds are buying treasuries or shorting or using derivatives or something on floating rate for 10-year. It's a very complex strategy. It's hard to get a straight answer on exactly what it is, but there's about $1.5 trillion of these is the number I've seen. You're not hearing a lot about it all, but it's clearly a big problem. And personally, I think this is why Trump went in and put the 90-day extension on the tariffs, is because this trade appears to be blowing up. It's kind of the hedge fund equivalent of picking up nickels and pennies and nickels in front of a steamroller. Eventually you're doing real well. All of a sudden, a mile down the road, something happens and it runs you over. And this is what's happened to these hedge funds. It's some of the biggest hedge funds in the world. And I believe this is an issue because I've just seen the way all assets were started to be dumped, particularly Friday, where there seemed to be just wholesale panic in the market. And then all of a sudden, yields started rising, which means people were in trouble. It's typically a sign. I don't think this is over yet, and I think this is something we have to watch closely, is how much trouble are these hedge funds in. Again, I don't know how we let these people do this. When we fill out our forms, our ADV forms, we got to report what we have, and we're not real big, and so it's not even quite as much. And I'm kind of like, why are you even messing with us? Why don't you? It's obvious who the problems are every single time, and it's not advisors investing retirement money. It's these reckless hedge funds, and so. This isn't over with the hedge with this SOFR trade, it's this basis trade, or whatever you want to call it. It's out there, it's real, it's clearly a problem, and that can destabilize the whole thing. So I don't think this is over. The other thing is the issue with China and the United States is a pretty hardball game, and if our financial system destabilizes, that's not bad. So this is something we're going to watch. Let's take a couple calls. Hey, Tom, welcome to the Max Show.
Hey, Ted. This morning I was sitting out reading Sky News, and the president or prime minister, I wasn't paying attention, of Poland, he's been in 10 years, so he's been in through both Trump administrations. He is all behind Trump and is trying to tell the rest of the European countries to settle down and relax. Everything's going to be okay. And as a sideline, I don't know if anybody recalls, there was something going on over Ukraine that really isn't news anymore. But they're looking at shutting that war down, too. He said, he was saying Trump is the only hope to end the Ukraine war, which, if you look at the news over the past 3 weeks, to tell you how small the Ukraine war is, have you heard anything about it? It's only been the economy and tariffs. That's pretty much all I had to say this morning.
Okay, well, thanks. That's a good point. Look, a couple. I think that there's Europe. It kind of breaks down. It's like the Poles they're kind of getting what Trump's doing. The Italians, the Greeks, I think the Spanish, Hungary, places like it. The problem seemed to be mostly Germany and France, which are more caught up in their globalism issues in battling us. And I do think the Europeans are going to come around. Moroni of Italy is coming over to see the United States, I think, this week. And, Italy has just become a huge powerhouse of manufacturing. They're materially more dynamic than the Germans. It's hard to be a dynamic industrial power when you're basically shutting down all your nuclear and coal power plants. But So I think we're seeing some stuff there, and I think they're going to work through this reasonably quickly. And these countries do need to show some respect, and we're starting to see who our friends are and who our friends aren't. I do think we're going to get a problem with the Ukraine. I think the Ukraine war, we're negotiating. They're going to try to get that thing done. I think they really, all sides want to get it done. I don't understand the Europeans' idea of wanting to continue it. It's obvious that, candidly, if this is the best the Russians can do, how do they expect to take over NATO? And so I don't know what Germany's even worried about, candidly. And so we'll kind of watch all this stuff. This stuff is all. But one of the reasons the Ukraine war is kind of off the thing is the media is trying everyone to focus on the tariffs because Donald Trump is destroying the economy. As we said at the beginning of the show, that this economy was already slowing down. It was going to slow down. Almost every single presidential election cycle, the economy slows down the quarter or two after the new president's installed because they got to get the new stuff in. All the reckless spending that's done to kind of make the existing president look good goes away. But so they're trying to. There's a huge push to blame Trump recklessly, chaos, destruction. I mean, honestly, if the Chinese could win the trade war and we have to close down every factory, every Democrat in CNN and MSNBC and the rest of them, Bloomberg would be thrilled by the fact that they knew Trump was a bad guy. And it's as I said earlier in the show, it's profoundly un-American. But if you got any comments, you can give us a call. We can get you in 713-339-1070 here at the Max Out Savings Show. So I think this market is stabilized for now. We have to see how this all plays out. We have to see what the economy is doing. Clearly, it's slowing down. And the issue we're dealing with is, look, we're not going to get a tax bill till May, June time frame, maybe 1st of July. The 90 days comes to around July 4th or something like that. So all of all this stuff is kind of piling up. We have to have a tax bill done. We have to have trade bills with everybody. We have to have a debt extension. All of these things have to get done. And so it's not like blue skies until after that. And remember, the administration knows they've got 6 months to sit there and break everything, so to speak, restructure everything, fix it up, and get the economy back on track. And so I don't think we're through this yet. I think we could stabilize and move a little higher, maybe up to the 50-day moving average or something. But I think you use these big pullbacks to take advantage or try to figure out where you want to be in the market over the next year or two. And I think that's sort of the play in here right now. That, like I said, that basis trade, this is not over yet. A 50 basis point move in 1 week in the Treasuries in a declining market where the economy is supposedly sailing into recession is a major concern. I mean, so there's clearly some issues out there, and the question is, versus Chinese selling of bonds or Japanese selling bonds or hedge funds in trouble, I bet this is hedge funds in trouble. And so, this is something we want to watch closely and sort of see what's going to happen there. I still like that. One of the things, the 2-year bonds, particularly some corporates in here, look high. As we said, we've been saying high grade corporates. We've been buying AA, triple, single A, of course, government bonds short term. We bought some BAA stuff, but it's something that we think is going to get, is either in the process of being taken over by a AA company or something where we think it'll can withstand a very, very severe recession like we haven't seen since 2008 or worse. That's the type of stuff we're buying. We're not, for our fixing, we don't want to own financials. We don't want to own finance companies. We don't want to distribution the people that have big, high capital needs. We want to own people that they might have high capital, but they have huge amounts of capital investment in place, like a railroad or something that we know is going to be there. It's always going to be it's always going to be there. Those are the type of things we want. We're not interested in media debt. So our debt picking, we think we put a little higher level of conservatism on it, because what we run is we want our debt to withstand a virtual depression. And this is not to say we think we're going to have one, but when we're investing in debt, sometimes it's 1 year, sometimes 2, sometimes it's 5 or 10 or more years, and it's hard to predict what's going to happen in the future. And so if I can sit there and have super safe stuff, that's what we want. We always want to be able to ride these things up. We want to be, when things get bad like they are recently, we want to be outperforming. We want to be up. And we can't always do that. We were actually down last week a little bit. We're now up again, and I think we went down maybe 1% or something. That's since year to date, by the way. Yeah, we're up now, but this is just because we work very hard on the allocating the assets, the retirement money in different asset classes, which and then we have some that which we think when something goes wrong will counterbalance the portfolio. And so anyway, but a couple things. If we're going to be writing our Max Out Savings Report, discussing a lot of this week, it's a free report. It goes out once a month, talking about all these issues, and it's completely free. If you'd like to be on the list, just go to the Max Out Savings website, sign up for the free report. Look, I will say this. I don't know of any other report that has basically warned you of crashes of the investment banks in 2007, that warned you of COVID in late January, first week of February of 2020, of a week after the war in Ukraine started, warned of inflation. We've done a remarkably good job catching these things ahead of everybody else. So the report is, I would say it's very well written. We have a few mistakes grammatically once in a while, but it is very well thought out. And we try to bring you stuff that other people aren't saying out there, so you can understand the world today. It's the Max Out Savings Report. If you need help with your retirement, we manage retirement money at Max Out Savings Advisors. We use Charles Schwab, the custodian of our assets, and we use our value investing approach. You can also get a free appointment with me. We'll look at your financial situation here in Houston, Texas. That's where we're located at. Just go to maxoutsavings.com. Oh, by the way, we just were awarded the 5-star advisor award, and we've had it for I think like 11 of the last 12 years. I think there's only like 14 other advisors in Houston that's gotten that award that long. So I believe we try to do a good job. Hope everyone has a great week right here on the Max Out Savings Show.
Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.